you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like-kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Hey, welcome to another Mastermind Deferred Sales Trust Capital Gains Tax Mastermind. We're going to help you become a Deferred Sales Trust expert every single week by spending about an hour with us as we break down what the Deferred Sales Trust is, what it's not, and how it can help yourself or your clients exit highly appreciated assets, all capital gains tax deferred, not using a 1031 exchange. My name is Brett Swarts, for those who don't know me. I'm the founder of Capital Gains Tax Solutions, and we're on a mission to help people escape forever feeling trapped by the 1031 exchange, by 30 to 50% in capital gains tax and appreciation recapture on cryptocurrency, businesses, real estate. And, I believe everyone needs a coach and a guide who helps you exit well, because you build a business or real estate or you invest and you do very well, but all of a sudden you're going to exit and you've never really exited before in this high of a level, this high of a gain. And you need someone who's day to day helping people navigate this even more than your CPA who's filing tax returns. You need someone who's going to help you exit every time in a way that's going to give you freedom, flexibility, diversification, and the ability to create and preserve more wealth with a trust or with a strategy or investing into real estate. That being said, I can't do this alone. I'm with some amazing people. Our goal is to build a dream team. I believe that if we work as a team, we can all achieve more. And this is part of our masterminding with clients, past clients, new potential prospects, as well as one of the best, I think, financial advisors in the country. We call him the CPA Whisperer. And I think he's one of the best because he thinks beyond just traditional investments. Although he's an expert in that, he thinks about tax strategy. He thinks about real estate. He's an entrepreneur. He's so many things. Please welcome with me, Jake Miller. Jake, how we doing?
Doing very well, Brett. Thank you so much for that introduction. It's great to be here, calling in from Dallas, from the Rosewood Hotel here in downtown Dallas.
Excellent. Yeah, I was just in Dallas actually last week at Fort Worth, the Gaylord Texan. We saw Tony Robbins, who was amazing, and a number of other real estate experts and even health experts. Some cool stuff there in Texas. Texas is booming. We toured a property, Jake, 200 units in Allen, Texas. You know, part of what we also believe in is multifamily value add properties is a great way to build your wealth and be able to diversify within the trust. And so you want to find deals and with operators that are doing and buying and operating at a high level. And so had a chance to tour with the Ellis Hammond with Symphony Capital Group, which was awesome. And it was a B-class asset. It had rents between $400 and $500 below post renovation, but it had a tennis court, it had the 2 pools, it had a fitness center. It was 13 acres, low density. In fact, across the street was the property. Across from the property was a high school. Looks like a university campus where Kyler Murray, you know, the star quarterback for the Arizona Cardinals, he played at. Just a A+ location in Texas. Love Texas. Anyways, that's cool. So what are you doing there, Jake? What's happening in Dallas?
We just have some companies, some businesses that are getting ready to sell, getting ready to buy, working with the people on both sides of the table and just helping make sure that the deals happen. It's a very exciting time for wealth to transition from one generation to the next, as well as individuals who are very entrepreneurial and those who are wanting to slow things down a little bit, where they can meet in the middle and make a deal happen.
Absolutely. That's one of the values of the Deferred Sales Trust, right? You can be passive or active. You know, if you want to retire, you can. And if you want to be entrepreneur, you can. In fact, Jake and I, we just closed the deal for an entrepreneurial client. He's actually, he's like around 40 or so. And he just sold a business. And right now he actually wants to be more passive with that pile of money that he just earned and was able to defer that tax. And he's going to go into about, 80% into securities. He's more heavily into real estate and businesses right now, but his take was, let's do some real estate. We'll do about 20% into some real estate, but he thinks there's kind of a good opportunities to buy when the market's down a little bit. And so Jake, talk about a little bit about that strategy and that thought. And he's kind of putting that bucket over there. He's kind of releasing and giving the trust in us to help invest and manage that. And then as well, he's going to go and try to make another pile of money with new businesses.
Absolutely. So this individual is an interesting fella. Again, as you mentioned, Brett, very young, very ready to keep pushing forward with a lot of other things. But he built this business up, sold it, made his money, captured it in the Deferred Sales Trust. And right now he wants it to sit on the side. He doesn't want to have to think about it. We went through the process to establish an appropriate portfolio in marketable securities that he would be comfortable with, that he would be happy with. And right now he says, hey, everything in the market right now is kind of a discount. And although there might be some volatility here in the short run, I don't want to look at this for 5 to 10 years. So let's just place it in a very good strategy as far as, overall what we're going to have as a portfolio. Let's just put it there. Let's forget it. And let's continue on with business as what he knows. He says, hey, Jake, I know what I know. And I know that I can make money. I know that I can build business. And I want you to build my asset over here. And so
absolutely. Yep, that's great. And so what we do here every day, by the way, or every Friday, we talk about deal stories that are going on or deals that have just closed. And then we also give you a little bit of the vision and why we're here. And then we start answering questions from anybody. It can be a live deal. It can be a potential deal. It can be a deal for a client. It can be a deal for yourself. And so we're going to be opening up for questions along the way. But if you have questions along the way, it'd be great for you to put in the chat, your first name, where you're from, and then the question. And the question can be about the legality of the Deferred Sales Trust. It could be about the investment options of the Deferred Sales Trust. It could be about, the flexibility of the payment stream. It could also be about estate tax, right, Jake? We're working on some very, some large deals for folks that are above those $24 million marks, married or 12 million single, meaning anything above and beyond that subject to that 40% death tax. Jake, if you want to touch on the value of the Deferred Sales Trust as it pertains to moving funds outside the taxable estate, without having to use life insurance, charitable giving, or having to give it all the way to, 20 kids that you maybe only have 2 kids. You can't gift it away fast enough.
Absolutely. And before I dive deep into that, Brett, one of the things that we really need people to focus on and be aware of is the sunset of the Tax Cuts and Jobs Act in 2026. Pretty much whatever the limits are right now, that's going to change. And very likely it'll roll back to what it was. And that's almost in half of what it is today. So let's say what it's going to be or what it was before the Tax Cuts and Jobs Act. That was $12 million, married, filing joint, to where if your estate exceeds that amount now or at some point in the future when you do pass away, everything above that amount will be given a 40% haircut. So when you go to the barber and you get a haircut, usually we're thinking like 5 to 10% to trim it up, make you look nice, but a 40% haircut is rather substantial and oftentimes causes family legacies and estates to get broken up, meaning you can't pass that big property. You can't pass that multifamily. You can't pass some of those other assets on because they have to be sold, and usually not in a timing of your choosing, because usually they say 6 to 9 months later, you have to pay that tax. So it's typically a fire sale, Brett, meaning there may not be a market, there may not be a buyer, but you have to liquidate to pay that 40% tax. However, you might have to liquidate at a discount, which means that your 40% tax of the proceeds that you actually receive ends up being much more burdensome. So there's oftentimes a nightmare around the estate or the death tax that people forget about and they don't think about, and they don't plan for. With the Deferred Sales Trust, we're able to actually right now freeze the value of these assets today and keep them. Now, we know, just like our client that we were speaking about just now, he knows how to do business, he knows how to grow business, right? Effectively, though, somebody like him, we can freeze the value of that in his estate today. And as it continues to grow in the future, it grows outside of their estate so that we can avoid, as you mentioned, Brett, without life insurance, without charitable giving, without all of these other complex strategies, we can use the Deferred Sales Trust to continue to grow that asset outside of their estate and limit or completely mitigate that death tax.
Yeah, and that's part of the vision here at Capital Gains Tax Solutions, is to help keep the wealth in the hands of the people. And who are the people? The entrepreneurs, the investors, people who have worked hard, taken risks, and have earned, versus a government that can waste it away pretty quick, no matter what side of the aisle you're on. In fact, it's no longer just about cash flow; it's about tax flow. Tax flow has to do with the $30 trillion of debt and more and growing, that the government is, printing more dollars, inflation is going on, and then they're raising taxes. And so you want to have a tax flow plan for this. And also, just to clarify, it does take selling an asset to move it into what's called the DST plus, or the DST 2.0, to remove it outside the taxable estate. And then Jake is correct. Once that's outside the taxable estate, anything that grows, that growth of that is going to be outside the taxable estate. And so you can either have what's called the stepped up basis, which, if you're familiar with the 1031 exchange, you can swap until you drop, is the whole concept, whereas your heirs can inherit the property at a stepped up basis, meaning they can walk away if they sell it for that same value upon your death, would be capital gains tax free. However, it's not outside the taxable estate. In other words, you can have one or the other, right? So you want to make sure you're clarifying like a laser, what is it you're trying to solve for? In other words, what is your B? What if your A is where you're at today and B is where you're trying to go, and B will be like the ideal outcome? What does that look like, right? And oftentimes people find us and it's like in a Rubik's Cube, meaning their colors and their different things represent different outcomes for them, right? One side could be, retirement. One side could be being more entrepreneurial. One side could be, optimal timing, buying, dollar cost averaging, diversifying. One side could be estate tax. Could be a number of things. And ideally, we're going to work as a team to try to bring this all congruent as much as we can for your situation by adjusting and looking at the strategy. And so estate tax is a huge challenge, and it's going to be devastating too if they cut those exclusions amounts in half or even lower. And the question is, do you want the ideal outcome to be outside your taxable estate upon exit or inside? And what would that look like one way or the other? The other side of it is, you just might think it's a good time to sell. Jake brought up a good point. He says, there's some times when it's just, we know the market's shifting, the industry is shifting in a lot of ways, and it's a good time to sell and a good time to buy some things, but it might be a good time to sell that real estate, to sell that business, right? To exit cryptocurrency. It's really 4 months ago, was it 5 months ago in crypto, right? We're really hurting now. But what gives you that ability to sell high and buy low? And that's really the Deferred Sales Trust. But Jake, so those are some of the benefits, but let's talk about also making sure you can sleep well at night, right? Because you don't want somebody to do the Deferred Sales Trust just to feel like they're going to be, subject to audits or subject to, stress as it comes to their taxes and such. So talk about the audit defense that's built in, Jake, and talk about the legal track record of the Deferred Sales Trust.
Absolutely. So the unique thing here is the creator and founder of this trust, him and his law firm, have been protecting it and maintaining the integrity for the last 26 years. And out of the 26 years, there's been 22 times that it's been either reviewed or audited. A review is oftentimes, hey, I just want to kind of cursory glance, take a closer look at what's going on here. Whereas an audit, oftentimes they're asking for something very specific and they're going to be a bit more thorough. In the case of a most recent audit, Brett, there was a deep dive audit on $120 million, was it $125 million condo skyrise building in California. And this involved not only the federal government, but this was California as well. And at the end of the day, diving in deep, nuts and bolts, looking at every little thing that they possibly could, they came out of it with a 0 findings and a 0 change, meaning they couldn't find anything to be disgruntled about other than the fact that this transaction occurred, money transferred, and none of it was recognizable for taxes in that year. And that's the exciting thing that we help people accomplish with this trust that is essentially bulletproof. And I say that, knock on wood, right? It's never been disallowed. It's been, what I say, challenged. It's been looked into, reviewed, and audited, but the law firm has properly defended it and nobody's abused it. So it's been used in its proper form. It's maintained its integrity and it's accomplished what we tell clients that it should accomplish. And that's very rare in the industry of taxation, Brett. Almost never do you bat 1,000 with any strategy. There's always somebody that's messed it up or somebody that has abused its original purpose, or their circumstance just wasn't appropriate for it, etc. We are very fortunate to be able to help clients with this because they, at the end of the day, have the confidence and the assurity that not only has it always proven and allowed for the deduction that the clients are taking, or the deferral anyway, but they have the law firm backing them that has been batting 1,000 since 26 years ago.
Absolutely, well said. And I'm going to share a few slides here to kind of give some deal stories, as well as show a few of the biggest things to overcome as far when it comes to, is the Deferred Sales Trust going to work, and what are some of the objections? So give me 1 second as I share my screen here. As here it comes. All right, make sure we can see that okay. I know it's blurry right now. So some of the biggest objections we have is the legality, right? Is this thing legal? We talked about that. The other objection is, hey, how do I know and by the way, here's some more on that. So we have, over 20 no change audits, and that includes the formal audits and includes California multiple audits. In fact, one was also done a couple of weeks ago, Jake, a $25 million deal. No change, no findings on the audit. So still batting 1,000, just over 3,000 transactions or so in counting. And then the lifetime audit defense is really important. State or federal, if you are audited, you want to make sure that you have someone who's going to cover that cost. There are those that approach Jake and I with different strategies that they want us to talk about or to sell. And the reason we say no to 99% of them is because they don't have this, over a couple decade long track record. They haven't been through the audits, or the actual attorney who's pitching the thing hasn't actually defended any of his clients on the structure that he's talking about. So it's so important to understand that it's not just the structure and the strategy, it's the team of professionals to help to execute this. And if you're wondering who are the team members, well, my role would be the trustee, third party, unrelated trustee. Jake's role will be the financial advisor. And then the tax attorney is the gentleman who, we call him the brain surgeon. We call him the Elon Musk of tax. He's brilliant. And he's the one who provides a lifetime audit defense and all the legal work. So a few things that are really important to point out, some of the benefits of the Deferred Sales Trust versus like a 1031 exchange. And remember, 1031 exchanges only work for investment real estate. They don't work for primary homes, cryptocurrency, or businesses. But you can buy back in and out of real estate at any time, or other business ventures, or other, at any time, all tax deferred with the trust, which is really incredible, right? You can sell high, buy low. Think of the 2008 crash. I just watched The Big Short. Anyone read that book? or watch that movie. My wife and I just rewatched it. We're like, well, just remember what happened, right? Not that we think it's going to be a credit crash like this, but there's changes happening right now. And to be aware of there's wisdom and learning from history. And so the idea would be here to sell everything high in 07 before the crash and buy back at 2011, right? In real estate, that's kind of the Monday morning quarterback. And the trust gives you the ability to do that, all tax deferred. Number two is the ability to have the income put back into the deferred sales trust, kind of like an IRA, kind of like a 401k, and invest it into investment grade securities. These are some of the biggest companies in the world, stocks, bonds, mutual funds that you have to approve everything, by the way, to approve of the investments and the movement of the funds. And that's where we work as a team to execute this. Number three is a seamless partnership separation. So you might have multiple partners. In fact, we just did a $13 million deal in San Diego where there was 4 partners. They bought it for $500,000 the land, built it to $4 million, and then exited up to $13 million. And that gain was about 40% cap gains tax. They were able to exit. In fact, one partner just wanted to pay his tax. No problem. He paid his tax. The other 3 did a deferred sales trust, and they were able to defer all of their tax. So it's a nice way to separate the partnership without having to have everyone go into a 1031. Number 4, can also save or rescue a failing 1031 exchange. Now, you do need to work with an accommodator, and we have one that we work with. That's a strategic alliance of ours. Go to capitalgainstaxsolutions.com or email me, Brett, at capitalgainstaxsolutions.com to get connected with them. It's really important that you have the team of accommodators that will actually accommodate. There are accommodators out there, Jake, and everyone else who's listening, who don't accommodate, and they don't want to accommodate for whatever reason that they have. But we just don't use those folks, and we use the folks that actually will accommodate. Number 5. Yeah, go ahead.
I think it's just an educational thing. People who have the education and the experience are able to help and assist in transactions like this that are not your everyday transaction. I was also going to comment that we have a limited partner and a general partner interesting case that we're going to be discussing this next week, and that's exciting. So that was kind of like number 3 and a little bit of number 4 there. And so definitely a current deal that we're trying to push on here this next week. Not to interrupt. Go ahead.
No, that's good, Jake. That's excellent. And then we kind of talked about 5 already. You can put it in diversified investments, like the deal Jake and I just did. He's selling a business venture. Good time to sell the business, and also a good time to diversify away from just deals that he's doing and do something that's passive and that's managed by a team. He still approves of it, and he has it, but he kind of wanted to put that bucket over there and let that grow. And basically knowing that as long as that grows pretty, conservatively, he can retire on that. He doesn't have to worry about, having to make all of the wealth in another business venture that may or may not go well. So for him, that's what's peace of mind for him. He can diversify and convert an illiquid asset like a business or commercial real estate into a diversified portfolio of liquid investments. And then we already talked about number 6, which is moving funds outside of taxable estate, which eliminates the 40% death tax. Okay. And so here are a couple deal close stories real quick. There's a $48 million deal done in Las Vegas, and this is actually done for the 5th time for these clients. And they exited over $100 million in multifamily investments. They were GPs, so they weren't, all 48 million wasn't theirs. The deal sold for 48 million. It was complex, and one LP actually used the deferred sales trust for their position. And then as the 2 GPs, they used it for the majority of their position, and the rest of the LPs got paid back. They were smaller accounts. Our minimum size, by the way, is $1 million net proceeds, $1 million gain per client per transaction, unless there's 2 at $500,000 each. In fact, here was another one they did just a couple of months prior, a $33 million exit in Phoenix. Here's a deal for a new client out of Texas, sold an $8 million piece of land. In fact, they tied it up this one's about 5 and then sold it at 8, did some improvements. And that difference was the delta that was able to go into the trust. Also, notice that it was in one day. It was short term. It wasn't didn't have to hold it for more than a year. Whereas the 1031, you got to hold it for more than a year. Oh, no, it's going backwards. Here's the deal in San Diego I was telling you about. It's called the Extreme Car Wash. And they were able to defer a lot of tax. It was like 12.75 million. So almost 13. Here's a deal in Denver, Colorado for a client. We had to do a partial Delaware statutory trust there, which often gets confused with the deferred sales trust, but they're different. Delaware is just a 1031 option. But this deal, they had a mortgage over basis. So we had to replace some debt over basis. And then the majority could go into the deferred sales trust. Here's one in Tucson, Arizona. This client, he's just like, Brett, I've been managing this property for 25 years. His name is Chuck. He's like, I'm 70 plus years old. He goes, it's senior housing, and it's not, I'm sorry, it's student housing. And he goes, you know how many calls I get, how much craziness has gone on? This is by a university. And he's like, you know what? I'm just done. And he goes, let's just put it 100% into the biggest companies in the world. If they all fail, then I'll pay my, I'm out. But this is an amazing opportunity. He sold at a good time as well. So that being said, I'm going to open up for questions here from any of the guests. You can chat in the chat, or you can unmute yourself, and then Jake and I are happy to answer those questions. And by the way, if you want to take action right now, you can go to capitalgainstaxsolutions.com to get started on your deferred sales trust, as we're waiting for anyone who has any questions whatsoever. We want to also welcome Juan. Looks like Juan is maybe the first time I've seen Juan here. Micah, nice to see you again. And there's just a couple of others here today. So anyone have any questions or thoughts? And otherwise, Jake might throw a question out there to answer.
Yeah. So Brett, I think that sometimes we get brought in a little bit late in the game after clients have already considered several other strategies that perhaps aren't as complete. They solve maybe just part of the concern, part of the issue, or a lot of charitable strategies. A lot of charitable strategies where at some point they're actually giving up the asset. I know that you've done maybe 2 or 3 now little podcasts on charitable remainder trust and some of these others in how they are different or similar from like the deferred sales trust, or what they accomplish versus what the deferred sales trust accomplishes. And I would love if you wouldn't mind just touching on that high level, take 2 or 3 minutes and talk about a charitable remainder trust and how it is, what it does versus what a deferred sales trust does.
Yeah, good question. And the big concept is the DST is like a CRT without the C. In other words, no charity is required. So a lot of our clients, even us, we're very charitable, but we're not necessarily 100% charitable. So again, back to the concept of what is your A? What are you trying to solve for? What's the problem? Where are you at? What's holding you back? And then what is your B? In other words, what's your ideal outcome? Where do you want your funds, your capital, your equity, your legacy, your wealth to be? And if it's, hey, I want it to be 100% with charities, amazing. Then you in fact don't need us. We would actually recommend that you go with a CRT. We don't do those ourselves. We specialize in the deferred sales trust. So we have other attorneys that can do that. And that's amazing. Like that's what you want to do. Couple things about the DST, why we think it might be wise to consider it, even if you are very charitable, is the fact that, like Jake said, eventually it's going to go irrevocably to this charity. In other words, once you pass away, it's theirs and there's no turning back and it's gone. And that can be great if that charity and their leadership and their values remain probably in line with where you want your wealth going to. But there are times when charities and leadership and things change, and especially over any decade period of time. And so you want to ask yourself, do I want the flexibility to be able to change or move? So from charities, and there are ways to do, and Jake could speak on this, where you can start to have like a charitable fund, and you have some flexibility about what charities it goes to. So there are some ways to do that, but just be careful the way you set it up, that you're not supporting, or even the kids inherit. We're going to inherit something, and now all of the funds are supporting a charity that you may or may not wanted to support because things have changed. So whereas the DST, it's flexible, meaning it can pass to your kids, and you can put inside of your living trust a certain portion of it to go to certain charities, right? Or to be directed to charities based upon what the kids approve. So if you have heirs that are in line with your values, they can flexibly move the funds to different charities based upon what they believe you as a parents were to be. So it's kind of complex, but at the end of the day, the deferred sales trust is flexible. We don't have to give it to charity, but you can. The CRT is less flexible in that you will be giving it to charity. And then again, the question is, are you 100% charitable versus 10%, 20%, 30%? Jake, how do I do?
I think you did fantastic. In fact, you hit the nail on the head with one of our prior clients. They were being pressured to do a higher percentage than probably they wanted, right? They were being pressured as, this is your strategy, the CRT and only the CRT, right? And so they were being told to do 100% CRT, when in all reality, they only wanted to do 10%. And they had this concern, and you brought it up a little bit. It's, what if they change the director in 2 years? Then we've just put a lot of our net worth and our assets into this foundation that we love and cherish and believe in, that might take a completely different direction with a different director. So what we were able to do is recommend at least that they do the Deferred Sales Trust. And at any given time in the future, after the new director is chosen, or whenever they choose, they can take 5, 10%, 20%. They can take whatever they want out of the DST, because they still have control of the reins. They still have control over the timing of when to take that money out as a possible taxable distribution that could then be offset by the CRT strategy.
It's beautiful, right? It's just the flexibility. We call it Netflix versus Blockbuster, right? It's the same reason we like it versus the 1031, which has the 45-day, 180 like-kind requirements, debt replacement requirements, whereas the Deferred Sales Trust has none of those, right? So you have no timing requirements, no like-kind requirements, and that flexibility of diversification, liquidity just creates a way that feels more like a seamless Netflix scenario versus having to drive to a Blockbuster and return the movie in 3 days. So these are all the things that we love about the Deferred Sales Trust. This is why we're here, to give you the pros and the cons. What are some of the cons though, Jake? I mean, we're talking about all the beautiful, shiny things here with the Deferred Sales Trust. Like, what would you say, someone, why wouldn't they use it? Like, what's kind of the downside?
If somebody literally should not sell their property, we were speaking with an individual, 83 years old, and he was looking for the most appropriate way to pass on his house. And it was a very expensive mansion of a house, right? And was considering, hey, should I do the Deferred Sales Trust and sell it? And should I sell it to my kids? And in all reality, that just didn't make any sense, because the kids could get a step up in basis and inherit the house, the physical tangible asset. There was not a need to have any sales transaction before. In fact, that would be to his detriment from a tax standpoint. So anybody who wants the asset itself, if it's not going to exceed the death tax limitations, that they should just allow it to pass upon death, which would get a step up in basis. Using the Deferred Sales Trust, we are essentially selling an asset, and we are no longer eligible for a step up in an asset that we don't have.
Perfect. Yeah. So that's one reason. The second reason might be the deals isn't big enough. Like, in other words, the math doesn't work. And what is the math? I mentioned it a little bit before. It's 1 million net proceeds, $1 million gain. And the reason is because on that gain, 25 to 50% is the tax liability. That's state, federal, Obamacare, and depreciation recapture, depending on the asset that you own and how much depreciation you've taken. In fact, those also might go up by another 6 to 8%. We'll see here federally. So that is important. We want to make sure there's enough pain, if you will, or enough tax liability to be able to defer in order to make sense of our fees. And I'll talk about the fees. And so the math has to work. Our fees are typically 1.5% of the first million, one-time fee, and 1.25 on anything above that on the gross sales price. That's to the tax attorney, and he provides all the lifetime audit defense. So if it's $1 million deal, you're looking at $15,000 one time at the close of escrow. Now, the recurring fees for Jake and I, on average, are about 1.5% to 2%, depending on how and where the funds are invested. So if it was $1 million, it'd be about $15,000 to $20,000. That's a recurring fee, no matter how and where the funds are invested. And so that's why we have to do the math. You think of it like this: if you're in California, which is 40%, you could sell at $1 million and pay 40% if the gain was $1 million. And that would be, a zero basis. So that'd be a $400,000 tax. Or we can roll all million into the trust and out earn, hopefully use the government's money, which, by the way, they're charging you 0%. It's like a zero interest loan from the government, that $400,000, 0% on that, and try to earn. We typically earning somewhere around 8% net of Jake and I's fees. Not a guarantee. We have to go make the money. That's the goal. But that's the thought. If I can earn and live off the interest, where most of our clients, that's how they'll structure it. They'll structure with interest-only payments somewhere between 5 and 6%, maybe, even though it's earning the 8, and they'll pay ordinary income tax on that. But essentially, the fees have to, and the ROI of the deal needs to make sense. And so that's number 2 reason why you might not use it, because your deal's not big enough. Jake, can you think of a third reason?
Third reason that may or may not make sense. Essentially, if they just want to spend the money. So this is often the first question that we ask, right? You and I, we both do a really great job at filtering clients so that we're not wasting their time, they're not wasting our time. What do you want to do with the proceeds? Some of them mentally already have the proceeds spent on like personal stuff. We met with a guy really early on when you and I first got to know each other, Brett, and this individual wanted to build his dream home with the entire proceeds, and they wanted to not pay any taxes on it. And, well, this is not the tool for that, because essentially, if you do use this business trust for anything that is deemed personal in nature, like your own Ferrari, your own home, something of that nature, then that is a distribution from the trust to you, and that is taxable.
Well said. Now, clarify, if that big home on the beach or in Colorado on Airbnb, Breckenridge, and it's a rental home, right? And you're renting it out for business purpose, no problem. In fact, that's one of our favorites, right? Because you probably made money doing something like that before. And as long as it's invested into an investment of business purpose, that actually spurs jobs, spurs people to build more properties, tax deferred all day long. In fact, one client sold a $2.6 million business in Alabama, and he used a portion of the funds to build 70 multifamily units with a partner in Tennessee. Ground up development, all tax deferred, right? And then on that development, he's also rolling the gains into the trust as well. So it's definitely works for Airbnb, rentals, construction, as long as it's invested in a business purpose and it's not your primary home. Now, can you have a car business that you're renting luxury cars out? Yes. It needs to be a legitimate business. And if the IRS were to parachute in 365 days, are you legitimately running a business? As long as you are, the trust funds can be used to partner with you and invest it into businesses, right? But we don't cross that line. We really clarify, like, is this gonna be your primary home? Okay, well then just take a distribution of that difference. And that's one way we solve for this, by the way. You might have a $5 million sale and a $2 million tax, and you put all $5 million into the trust, but you may not need $500,000 or $1 million to build that house or for that down payment. Well, let's take an immediate distribution of that. You pay your tax on that. Use that for the down payment to take on your next property, your next personal use. It's your money. You can pay tax on it. We just want to make sure we follow the rules so that we have integrity here. So, yeah, Jake, those are the main ones I can think of. Anything else come to mind there, or should we've talked about the legality, we talked about flexibility, talked about reasons why you maybe wouldn't use the trust. How about just the CPA, Jake, that just says, I've never heard of it, and I wouldn't do it. I just wouldn't do it. And you give them all the evidence and all the stuff, but talk about that skeptical CPA who might just tell him, I don't know if I would do it because I don't know if I feel comfortable with it. What would you say to the client whose CPA is saying that?
Yeah, it's interesting. I've had the great opportunity to work with CPAs from all over the country, and they're not all created equal, and a lot of it just has to do with their experience, what they've done before, what they're comfortable doing. If they've never done it before, Brett, let's take it out of this example for just a second. Let's just talk about late S elections. How many people take an LLC and they convert it to an S corp, but then they retro date it back, which is allowable. You're allowed a late S election, right? But if a CPA has never done it before, and I go to him and I say, hey, I've got this business and I made all this money, and I like to save money on payroll taxes. I like to do the late S election. Do you think that's a good idea? They might just say, well, I can't really get behind that strategy because I've never done it before. I mean, they may not say it that way, but how could they get behind it without doing research and getting educated and then understanding the pros and the cons and what to provide the client in a recommendation? And if I'm not paying him or her an hourly rate, right, to review this and figure it out, they might just say, hey, I can't invest my time into something that you just sprung on me as a surprise. That's a little bit of what we find occasionally with the Deferred Sales Trust. Sometimes the clients see our webinar, Brett. They hear the podcast, they're in the gym pumping iron, whatever, and they hear about this, and they have an opportunity to participate, and they call up the guy that files their taxes every year that has never done one of these before. and they get a similar response. It's like, well, I just don't know. I can't tell you that that's a good idea because I've never done it before. Now, again, they usually leave off the last part. They don't tell, nobody likes to admit that they're missing out on experience or education. They always want to be the smartest person in the room for the client, which is why we work really well with other professionals. We invite clients to bring their advisors to the table. And, from day one, let's get it all out in the open so that we're not wasting anybody's time. If somebody needs time to be educated on all of this stuff, a lot of times we have them sign a little NDA, right? So that they don't try to recook our own recipe, but that they very openly can enter in and we can pull back the curtains and show them exactly what the chef and all the cooks do in the kitchen.
Yeah, absolutely. Very well said. I love that analogy. It's so spot on, right? And by the way, we welcome CPAs, and 99% of them who spend some time with us, who sign the NDAs, who go through the process, they all join us, right? And we work great with other CPAs. In fact, you guys are so valuable because you have that know, like, and trust with them for so many years. And so our goal, and we actually invite the client to bring in their CPAs. But here's the key: bring them in the passenger seat, right? Don't put them in the rearview mirror or put them in the back seat. Like, go through the journey with them together. And sometimes you got to give the CPAs the benefit of the doubt, because they get approached to some of this stuff like last minute, like, oh my gosh, the client hasn't planned or pre-planned. And you're right. They go into a webinar or a podcast, they speak with us, and their deal is, it's all the emotion, all the intensity of a $10 million deal is coming down, and it's 2 weeks before closing, and they're asking their CPA to give their expert opinion. All right. It's almost like emotionally, the client is trying to put emotionally on and expertise wise on the CPA to make this call. Like, well, would you do it? And the CPA is going, well, we don't even have time to go. I have to, do these things. And I'm up against these, September 15th and October 15th and April 15th dates. And so the key is pre-plan. This is part of where we work on a no cost, no obligation basis. Nothing is charged for talking with your CPA, talking with you, actually setting up the trust, reviewing the PSAs, putting the documentation together. All of it's there, no cost, no obligation. You only pay us at the close of escrow. But we want to encourage you to get with your CPA early, get with us early, pre-plan the exit before you exit, and don't spring it on your CPA last minute. However, I will say, I had my ACL surgery done, right, Jake? And I remember walking in to my general practitioner, and he did the test, right? He did, if you know the test where they grab your knee, you ever do this? Has this ever happened to you? And they move it. Right. And they're like, and you think that, you're looking at them like, and I had just signed a scholarship. Okay. I just signed a scholarship. This is like my dream come true. 3 weeks prior to that knee injury. Okay. And so this is like 2 months before season starts. I'm all excited. And the swelling went down. It's been a couple of weeks. So he's in there and he's testing it out. And guess what? I wanted him to say, everything's fine. Everything's fine, right? That's what. And so I'm looking at him as he's doing his test, and he's doing this, and he looks at me and he goes, "You're good." And I go, "Well, what do you mean I'm good?" Like, no, I don't think there's any structural damage. I don't think the ACL has ruptured or teared. And I said, "Oh wow, this is great news." And I'm all excited, and I go back to my coach who I just signed this big scholarship for, and he just committed to me. I'm like, I'll be back. Just give me a couple months of rehab. There's no ACL. I don't have to take the year off. I go home that night, and I talked to my brother about it, and he's like, that's interesting. I had a friend who a similar thing happened, but it didn't turn out so well for her. In fact, she played at UC Davis in basketball, and she signed a scholarship, and the person did the knee test, and she same thing and said, "You're good." She went back and she completely ruptured everything. Like, he became worse. And basically what the conclusion was she never actually had the ACL. The test had failed. And so he goes, go back to the doctor and ask the doctor to give you an MRI. And so he goes, just tell him to give you an MRI. Like, you want to be extra safe. This is your your college scholarship. This is your basketball career. You don't want to take a risk on a guy just doing this. Right.
Absolutely.
So I go back to him and I say, hey, I want to get an MRI. He's like, you don't need an MRI. I go, no, I really want to get an MRI. I want to be safe. He goes, you are wasting your time. You do not need an MRI. You're fine. You're going to waste your time driving down there. It's really expensive. You don't need an MRI. I was like, no, I really want to just be safe. Like, I know you're a good doctor, and he actually has a general practitioner that did like a sports medicine focus. Right. yada, 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 yada. And he's very convincing, but I said, I'm going to get the MRI. So he goes, fine, you're wasting your time. This is how I did it. And he signed the prescription. He's like, kind of like upset about it. I'm like, all right, whatever. I go down there 3 weeks later, we get the results back. And guess what, Jake? He calls me up. I'm at practice. Hey, Brett. And he's just zero emotion. Yeah, we got your results back and your ACL is completely ruptured. You need surgery. You're going to be out for a year. And it was like a ton of bricks. And I'm like, what in the world? So my point of all of this is serious, right? Your exit is very serious, and it takes looking at and going through and not just trusting your general practitioner, right? For something that he's not a specialist, something he's not doing everyday surgeries, right? Especially if they're not even going to do the x-ray, right? So I would encourage you to ask your CPA to please. This is very important to me. I know you probably think it may or may not work or for whatever reasons, but would you please come on with Brett and Jake and his team, right? Go through it, do the x-ray if you will, let the MRI go through for the deal and sign the NDAs and go through this process. And if you do, and at the end of that, you do feel, perhaps it doesn't work, I'll have to make the decision at that point. But I am confident, and at least Capital Gains Tax Solutions and Brett and Jake are confident that if you go through that process, you will feel much better. Okay. So Jake, any thoughts on that story?
It's absolutely true, Brett. I mean, it's a great parallel at, what CPAs and what other people do all day, every single day. If this isn't it, bring in the people that it is. And this is what you and I do every single day. We're helping people. Everybody's situation is a little bit different. And that's why it's not something that you just learn overnight. This is hundreds of cases later. This is, meeting with people thousands of hours. This is having a lot of discussions, doing a lot of research so that we can be the subject matter experts and we can sit down with the clients and we can, based on their scenario that is different from anybody else's, give them the advice and actually do that x-ray.
Very well said. So hopefully this has been really good for everybody. If you're finding value here, please rate, review, subscribe. Please hit the like button. If you have any questions, you can always join us every week, every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern, where Jake and I and the team will be here to go through and help you to become a deferred sales trust expert. We want to be your guide. We want to help you out. Yes, and so we do have maybe a comment here. Let's see here, Gordon. Hello, Gordon. Looks like Gordon says he was in the ER here. Let's pull this out. I was in the ER yesterday for my knee. They won't be able to schedule an MRI until next week. Wow, it's Gordon, I wish you very well on that MRI, and I hope that your ACL and your MCL and everything else is structurally still there. And it's and whatever knee challenges you might have. I actually had 2 ACL surgeries, my right knee, my left knee. I have new knees now, and they actually ended up taking my hamstring. They cut my hamstring, and they went in a less invasive way that wasn't just a big old cut down the middle, which helps to heal faster. I was actually walking in 7 days on slowly with crutches, but and then let the crutches go in 7 days. So there are definitely encouragements there with the right doctors. So that being said, does anyone have any questions for Jake or I? We are happy to answer those for you. And before Jake answers that, or anyone we answer that, Jake, where can people find you if they want to get in touch with you, Jake?
Absolutely. So strategictaxsolutions.com. There's a little booking tab, as well as the 800 number, 1-800-773-1848.
Excellent. And if you want to get in touch with me, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Our number is 916-886-2986 as well, 916-886-2986. And then check out the new book that's coming out on Amazon here shortly. It's Building a Tax-Deferred Exit Strategy. And in fact, we have the Jake Miller, extraordinaire. He is in the book. We have people like Kevin Harrington from Shark Tank in the book. And the whole goal of the book is to help you to unlock your ideal wealth plan when selling assets of any kind for yourself or your clients. And it's my journey to the Deferred Sales Trust. It has multifamily syndicators, financial advisors, experts in here talking about building wealth, exiting well, and just having solutions, right? Because at the end of the day, people people get paid when they solve problems, right? The bigger the problem we can solve, the more we can get paid, more people we can help. And that's why we're here. That being said, we so appreciate everyone out there. Looks like we have no questions. Please rate, review, subscribe. Please share this with them. They can inspire. Please comment any other questions. If you're watching this on YouTube, we'll try to get to those questions next week as well, if you're watching on the replay. And we will talk to everyone again real soon. Bye, everybody.
Bye.